why only fools and gamblers, not investors, will put money in this market. What caused a financial meltdown? Is it due to the usual business cycle of booms and busts? Is it due to greed? Is it due to accounting gimmicks and fraud? Is it due to government deregulation? Is it due to bank overconfidence? Is it due to economists? No. The cause of the financial meltdown is more fundamental. It is due to our loss of control and power over the board of directors of public companies. Until we regain control over the board of directors of public companies, only fools and gamblers, not long-term investors, will put money in the stock market.
When you see the greed and the concentration of power within, greed's a good idea to run on?
Well, first of all, tell me, is there some society you know that doesn't run on greed? You think Russia doesn't run on greed? You think China doesn't run on greed? What is greed? Of course, none of us are greedy. It's only the other fellow who's greedy. The record of history is absolutely crystal clear that there is no alternative way so far discovered of improving the lot of the ordinary people that can hold a candle to the productive activities that are unleashed by a free enterprise system.
But it seems to reward not virtue as much as ability to manipulate the system.
And what does reward virtue? You think a communist commissar rewards virtue? You think a Hitler rewards virtue? You think, excuse me, if you'll pardon me, do you think American presidents reward virtue? Is it really true that political self-interest is nobler somehow than economic self-interest? You know, I think you're taking a lot of things for granted. And just tell me where in the world you find these angels who are going to organize society for us. Well, I don't even trust you to do that.
It was not too long ago that our markets worked well. In reward for their good work, management and the board of directors received bonuses and stocks. We trusted the CEO to tell it like it is. If he did not, the board of directors would fire him.
Ow.
Or, we shareholders would fire the board of directors.
Ow, ow, ow.
Depart, I say, and let us be done with you. In the name of God, go.
If the CEO committed fraud, for example, by cooking the books, the Fed will put him in jail. Based on the annual report, we think that projected that our stock would double in about 7 years. With great confidence, we invested our savings in corporate stocks and bonds for the long haul. It's a very simple modus operandi. First, of the short-term profit of the firm. Second, get a huge bonus in cash and stocks. Finally, dump the stock at the high. It's that easy.
There's an old saying in Tennessee, I know it's in Texas, probably in Tennessee, that says, "Fool me once, shame on you."
Enron dropped from over $90 to less than 50 cents today. Skilling CEO of Enron convicted of fraud. Bernie Ebbers sentenced to 25 years in prison. Kozlowski convicted of fraud. HCA agrees to pay $745 million in civil penalties. At the early stage, the CEO aims for a very high-risk, high-reward strategy. While we might invest in junk bonds, the CEO sells subprime mortgages or sells SUVs. The risk is that the subprime borrower may default or gas prices may double, but the reward is doubling or tripling of his profit. The SEC will not allow us to buy stock on margin at more than twice the leverage, but the CEO has no such constraints. By increasing his leverage up to 50 times, he doubles his money if the investment returns 2%. But he bankrupts the firm if the investment loses 2%. At the last stage, the CEO engages in fraud. With regulators gone fishing, he thinks he won't get caught. He figures he will be out of the firm before regulators catch on. At worst, the company, not he, pays a small fine. The CEO creates a cycle of pump and dump, where short-term the stock rises, but long-term the stock crashes. Despite the machinations, the board will not fire the CEO because the CEO appointed them, or, like him, they also get cash bonuses and stock. Even if the majority of us seeks to fire the OD, we cannot do it because, firstly, the CEO has incorporated in a CEO-friendly state. A shareholder lawsuit will get nowhere. Worse, the CEO appoints his own compensation committee. Secondly, the CEO uses company resources to put only his slate on the proxy ballots. Even if there are 20% of us shareholders, it will be prohibitively expensive for us to put up our own slate. Lastly, over the years, we have put more and more money into stock indices, mutual funds, and ETFs. What we may not realize is that we have entrusted more and more of our proxies to money managers. They usually vote with management, or they lend our stock to short sellers who want to drive our stock down. So even if more than 51% of us want change, management wins and we lose. The CEO going to jail? Forget it. In just the last 10 years, Wall Street has spent over $5 billion on politicians, 3,000 lobbyists, Washington officials, and direct campaign contributions. The Glass-Steagall Act of 1933, put up during the Great Depression, was a wall separating regulated commercial banks from deregulated investment banks. That wall broke down when three Republicans, Graham, Leach, and Bliley, introduced the Graham-Leach-Bliley Act of 1999. This act was Robert Rubin's last act as a Treasury official of the Clinton administration. On his first act as Citigroup, together with the Commodity Futures Modernization Act of 2000, which deregulated financial derivatives. Companies became impossible to regulate. The new law shackled regulators.
Mr. Chairman, we do not have a crisis at Freddie Mac, and in particular at Fannie Mae, under the outstanding leadership of Mr. Frank Raines. Everything in the 1992 Act has worked just fine.
I don't see anything in your report that makes it safety and soundness problems.
And I'm tempted to ask how many people in this room are in the payroll of Fannie Mae, because what they do is they basically hire every lobbyist they can possibly hire. They hire some people to lobby, and they hire some people not to lobby so that the opposition can't hire them.
It's crazy to have regulators owned by the people being regulated.
The Fed is a mess of conflict of interest.
It is a big bunch of Goldman executives that you see throughout.
Greenspan was a consultant to Wall Street. He was Charles Keating's go-to guy, and his reputation was for giving Wall Street whatever it wanted. That's how he became chairman. With foxes in the henhouse, will regulators stop this rigged game? Emmanuel profited from Freddie Mac scandal. Geithner okay's AIG bonuses. Geithner fails to pay taxes. Hedge fund paid Summers $5.2 million. Greenspan, Rubin, and Summers. The post-regulation of financial derivatives. Brooks Leaborn vindicated. Ratner involved in pay-to-play kickback scheme. Former Freddie Mac CEO Franklin Raines advised Obama. At a minimum, we must be able to bar brokers from casting votes without our consent, bar money managers from casting votes or lending stock without our specific instructions, compel the CEO to allow proxy access if we are at least 10% of the vote. Make our regulatory institutions professionally managed, not controlled by private interests. If you are a long-term investor, the CEO will take you to the cleaners again. If you are a gambler, you may try to time the market. Until we regain control over the board of directors of public companies, only fools and gamblers, not long-term investors, will put money in the stock market.